Hello, welcome. This is Michael Brooks and Will Allen here with Centera Capital. We have a market update for you. We're going to be having a long discussion here through some of the most important things going on. We know right now, top of mind, Will, obviously, Russia, Ukraine. We've got to talk about it. So I just wanted to start off by saying, though, we recognize this is a very sensitive issue right now. It's very sad what's going on. There are lots of people being displaced, having to walk hundreds of miles to escape the country. While we talk about this, I know it may come across as being insensitive in the beginning, but keep in mind, our clients want to hear about really their money, and that's what we're going to talk about. So I want to make sure I just at least get that out of the way, that we recognize that this is really a very sad event going on in the world. It's caused a lot of people to question the whole world order as we know it. We really did not expect this to happen, and frankly, it's just quite insane. So I wanted to talk through it, but just really realize that this is very, very hard what a lot of people are going through right now.
Yeah, no, you're exactly right. And I think, what's interesting is this is the first kind of conflict that's impacted the markets in this way since kind of the advent of social media, right? I mean, if we think back to conflicts that have roiled markets over the last, say, 50 years, whether that be, when we went into Afghanistan or the Iraq War or the Gulf War or Vietnam, going back, way back, you didn't have social media, didn't have some of the images and views that now we can get in almost real time of what's happening over in Ukraine. Yeah. What's happened to the people when you get to see, some of these, pictures or videos of what's taken place.
Right.
It's really tough to look at.
Yeah, it's a little, we had sort of, I remember the very first time that I was impacted by the power of Twitter or Facebook was the Arab Spring and a lot of the protests. Mm-hmm. This is very different. We're talking about tanks and jets being shot out of the sky that we have live video of. And really, I think what's important, as we can see with the freedom of the press that we have here in the West, as opposed to what Putin is doing with Russia and suppressing and even ignoring the fact that this is even a war, is quite stark to see that disparity. When you have so much video evidence now, I just can't imagine how much control he must have over the media there to suppress this kind of thing from getting out, when we have all sorts of means of getting information, whether it be through the social media sites or cell phones. Everybody's got a cell phone now taking video, and it's quite, you're right, it's quite crazy to see. We're getting moment by moment analysis and people out there in the streets showing fighting and everything. It's crazy.
Well, so obviously this weekend, I think probably the biggest story as it relates to the markets was you had another huge surge in the price of oil, right? We, at one point last night, and we're recording this on Monday, but last evening, oil hit $130 a barrel. It's right
now. Which was not till 2008 that we saw this kind of value, correct?
Right. Summer 2008.
Right before the financial crisis in the summer.
Exactly.
Spiked up, yeah.
Yeah, that was the last time we saw a price this high, and it hit 130. It's at about 119 right now. But you've basically had, about $30 move in oil in the last week or so per barrel, which, oil price spikes, temporary spikes in oil, and really any other commodity happens. This one obviously is really critical because energy plays such an important role in the economy here and around the world. But, one of the things that the market's grappling with now is, when does oil hit its ceiling and start to come back down? If you look at the chart of oil, and we'll put one up here so they can see it, but if you look at it, oil prices have gone what you'd call parabolic of late, which means they were already going up.
Yeah.
You know, we already had a supply-demand imbalance even before Russia and Ukraine really happened, you know, because you had economies reopening and you had this surge in demand and supply hadn't really caught up, right? And so we already had that. Then you add this into the mix. And over the weekend, concerns, or not concerns, but the thought that, hey, look, there's going to be sanctions on Russia energy, right? That we have so far wasn't going to happen, but the thought that, okay, if you take Russian oil and you kind of take that offline for Europe and the U.S., etc., you got to make that up somewhere, and that's what's hard to know. But anyway, so you had prices start to skyrocket, but the big question is, when does oil peak and start to come down? Because I think what we will see at some point, and we don't know what the number will be, but at some point you're going to see it peak, and then you're going to see it come back down and have a significant fall in a short run. We saw, for example, last year lumber do that. Lumber just skyrocketed. It basically tripled last year, and then it basically lost 50% in about 2 weeks as it came back down because it went parabolic. Anytime a stock or a commodity, you know, just goes berserk to the upside,
right.
You then see it start to come down. The question is, when are we going to see that? And no one really knows that at this point.
Yeah,
right?
I mean, it was like the perfect storm if you think about it. Like you mentioned earlier, where we were just getting out of COVID. I guess over really, I've noticed personally. I don't know the data to it, but going to work, driving, the traffic that we can see has just started to crank up again. So I can see that where we were kind of 6 months ago, or really even over the holidays, as far as the demand for oil probably wasn't nearly on the upswing as much as it could have been in the past. But because we were coming out of COVID, it all of a sudden, okay, demand's back, but the supply wasn't there because of the lag time between, you know, what we were doing with being inside, not getting out, staying in our houses, and now that's with that timing of that change. Right after that, after we started to see some great moves up when the economy's really roaring, then we get this coming out with Russia, and it's just so right now, $130 down to $119. We don't know what's going to happen from here, but it would be hard to see going up precipitously from here. Doesn't seem to make any more sense.
Yeah.
I mean, it just seems like there's going to be somewhere to hit a ceiling that demand will come back down because of it. So,
and we have seen oil spikes in the past, like during the Gulf War and during early days with Iraq. I mean, it's not unusual for oil to have these moves where it goes screaming to the upside for a period of time.
Right.
You know, here's an interesting number that we got today, or the two of us saw from Fundstrat, which is a company that does research, independent research. We subscribe, and they have amazing data. But they pointed out that look, you know, gas prices going up. You know, nobody likes to pay more on the gas front.
No.
It certainly hurts wallets. You know, across the world and here in the U.S. One slight positive here is that 1980 was one of the occasions where we saw oil prices skyrocket. At that time, gasoline costs were about 6.5% of the budget for the average American. So about 6.5% of their cash flow went to gas. In 2008, summer 2008, you were mentioning that when oil prices skyrocketed. At that time, it was 4.5% of the budget for the average American. Today, with the fact that, you know, mileage is better as car manufacturers, there's more electric vehicles and hybrids, etc. It's down to 3% of the budget. And so, you know,
this is, just to clarify, this is like a household on average.
Yeah.
If you take out, you know, this is how much they spend on housing or groceries.
Yes.
Gas was about 4.5% a few years ago, 6.5% or so back 30 years ago.
Yep.
geez, almost 40 years ago.
Yeah,
On
I know, man. It's
But
crazy.
anyway, but now it's only 3% of our average budget for the household.
Yeah,
Right.
and so the point is that we are better equipped to handle it now. This spike in gas prices, a big question is this is. And obviously, we don't know the answer yet. But a big question is, how long do oil prices stay at really elevated levels? I mean, typically with commodities, any kind of commodity, when you see the moves go parabolic, when prices scream to the upside, typically what happens is you get more supply start to come on board. The great example is, times when, for example, corn goes way up in price. So farmers decide, hey, let's plant more corn. And so then you have a lot more supply comes on, prices then drop precipitously and get back down to normal levels, right? And so part of it here is going to be not just, hey, what new supply will come on board. We possibly have new supply coming on with Iran. We're going to be talking to Venezuela. I heard, look, these are not great people, when you're dealing with the Iranians and the Venezuelans, and et cetera, and the Russians. But we're going to have more supply. We're also going to have some demand reduction. If gas is $5 a gallon, people are going to hesitate a little bit. They're not going to do as much driving as they might otherwise do.
Right. And again, going back to the earlier point, coming out of COVID, I don't know. I looked a couple of weeks ago. I can't remember exactly the timing, but it was just a few weeks ago. They were still saying that only a third of the American workforce is actually back in the office.
Yeah.
So there's still not nearly the kinds of activity as far as us being mobilized as it was just before the pandemic. So it's going to be very interesting to see how long this rise of oil might be. It just doesn't seem like a long-term situation that we're in. This is a very big reaction to a wartime tragedy that's going on. And so I think it'll be interesting to see what the ballast, what else, the demand coming down as opposed to the supply going up, if they can manage to get the global community on board and OPEC coming out, maybe changing their supply lines and such like that. So, yeah.
Well, to your point about it not seeming like a big, a long-term issue, it's easy to forget. 2 years ago, we were told that a year and a half ago, oil prices actually went negative briefly, if you remember. We had a period of time about a year and a half ago when oil prices briefly went negative. But oil prices were sitting at $40, $50, $60 a barrel for a long time there. And we were told, hey, look, oil prices are never going to go much higher than this because there's too much supply. Everybody and their mother has oil and is pumping and drill baby drill and all of that kind of thing.
Right.
And so the point is that the pendulum swings too far all the time with prices of commodities. It goes back hundreds of years. And we're at a time here in the last month where prices have skyrocketed, gone up.
Yeah.
2 years ago they had plummeted in price and they were too low. So I agree with you that this is not a permanent thing by any stretch. It's just a question of, are we talking about another week? Are we talking about another month? I mean, it's just really hard to know for sure. And obviously, the market doesn't know. And that's why you're getting these, these furious moves, not just in commodities, but across financial markets in general. I mean, we've seen crazy moves in fixed income, which is normally a very sleepy area, but the yield on a 2-year treasury or a 10-year treasury had moves last week in 1 day a piece that you just don't see.
Yeah.
And that where the market's saying, hey, we don't really know how to handle all this, what's happening in Russia, combined with the issue that the markets were struggling to figure out before Russia, which is what's the Federal Reserve going to do? Last week, Jerome Powell was in front of the House and in front of the Senate, given his annual updates, right? And was talking about their game plan for increasing interest rates, and the markets are having big swings around that, just trying to figure out, okay, are we going to get 3 or 4 interest rate hikes this year? Are we going to get 7 or 8 interest rate hikes this year?
Because right before this happened, we were sitting, the market expectations, we were going to get 7 increases this year, and very, very highlighting the fact that a lot of market participants wanted a 50 basis point, or basically 2 and 1, starting this month.
Yeah.
And that seemingly is off the table now, as we've entered a completely new era, I would say, from where we were just a month or two ago. I mean, it's just very different and an unknown compared to where we were, where the market was hot, things were smoking. Unemployment has been incredible. All these things that really tried to push and encourage the Fed to start raising rates to tame inflation. So that's kind of the other swing, is that sort of the Federal Reserve, inflation, getting that under control. And we see, obviously, inflation is going to be it's going to be included in a lot of numbers of oil's making that even worse.
Yeah.
Currently.
Yeah.
Right? So that's where we don't know what's going to happen, because there were 7 expectations for increases. Now we've gone down within a week. We went down to 4 rate rises that they think may happen.
Yeah, we went down to 4 as we were heading into Powell's testimony last week, and then the next day it went back to 6. So it's not at 7. We're at 6 currently, priced in, or we're talking about the Fed futures here. Traders can look at and make their guesses there as to how many rate hikes there's going to be. So, I mean, nobody really knows. And again, what the market's been working through before Russia-Ukraine was on the radar here was that in November you had markets at all-time highs. You had markets expecting maybe 3 rate hikes in 2022.
Yeah.
And, up until mid-November, you had the Fed saying, hey, inflation's transitory. We're not real worried about it. Don't worry about it. They were, still, doing their quantitative easing, $120 billion a month. We did a video a little after that time talking about the pivot and the change that was going to be necessary. So since then, till today, and we've written about this on our blog, we've kept folks updated, but the market's gone from, hey, look, don't worry about the Fed. They're not going to have to do, a lot of rate hikes. Inflation's going to calm down. To, a 5-alarm fire. The Fed's way behind the curve.
Yeah,
they needed to do 7 hikes. Goldman Sachs and Bank of America have said, really, 7's not enough. We may need 8 or 9 interest rate hikes, tripping over themselves.
Right.
To say,
I think they were shocked by that one number, the inflation number being, 7.5%.
7.5%.
Yeah, and that caused things to... Because at this point, especially with where we thought we were going to be with the virus, that this would kind of change how countries were getting supplies moved around and everything like that. And that's one of the things I think is going to be quite interesting to see with this. I don't even want to know the war that's going on right now between Russia and Ukraine. Is that going to cause even further supply chain issues? I don't know about that, because I do feel that one thing that is quite a positive that we have going is I really think that the global community is pretty solidly united and thinking, what is this? What just happened? Is Putin out of his mind? Well, we've pretty much come to determine that that's definitely the case. I mean, this is very unexpected. And so, but it'll be interesting to see what the effect is going to be down the line if with this oil impacts getting ships to us and all that kind of things that will affect the supply chain all around, whether it be couriers and etc. What's that going to do? That's going to be interesting to see.
Well, on that note, one of the positives I think has been that the COVID numbers have fallen so significantly, and you have, a lot of return to normal as best as you can, and pretty much every state now has said, hey, look, we're trying to return as best we can to normal. which means more, kind of reopenings,
Right.
people going back to work. I read a very interesting article last week because last week you had a really strong jobs report. And one of the really strong...
Yeah, unemployment went down to 3.8%.
Yeah, 3.8%. And one thing that was really nice is you had a surge in the labor participation rate. This number has not bounced back like we wanted to see. A lot of people had not re-entered the workforce, but the point was we got a combination of the COVID numbers really going down, so you had people jumping back in because of that. And then also there was speculation that the inflation shock that people are seeing with regards to higher gas prices, higher food prices, etc., are really forcing a lot of people who weren't coming back in, who have said, okay, I need to get back to work. I don't like like this inflation I'm seeing. It's a little bit freaking me out a little bit here. I don't like paying a lot more for so many things that we're having to pay more for. So look, in a way, if it means more workers can get back into the labor force, that will help the supply chain, because there are a lot of companies who have said, look, we just don't have enough labor. We can't find enough people. And so if they're able to get some of those people back, it should help some with regards to, getting supply chains back in order.
Yeah, I mean, and we also had a lot of assistance coming out of the federal government through COVID relief, right? And that really pumped up some of the numbers there but households have got a lot of cash on hand still. So we're quite insulated in a lot of positive areas where this could have been much worse if we were in a completely different economic cycle, for instance. But boy, that seems to have been a lot of the theme when you hear from, investment guys talking on TV or on the radio, or seeing a lot of articles that we've been reading, and that a lot of the stock moves that have happened the last couple of weeks has been more of a pivot to the U.S. actually, instead of all hands on deck. We got to sell. I mean, we had a very, very different experience with COVID.
Yeah,
that was a quick 32
March 2020. Yep.
And right now things are not great with the news, etc. But I also want to keep things a little bit in perspective here. That markets are having another down day today, and we don't know what's going to happen the next couple of weeks.
Sure.
I'm just saying, as of right now, what we see on the horizon, markets have only been down about 10% on average, with the S&P up to Friday year to date.
Yeah, so on that note, so last week, like you mentioned, European stocks really got hit the hardest because they're the most directly impacted by what's taken place over in Russia and Ukraine, obviously. So European markets were down about 10% last week. U.S. stocks were down about 3%. So the U.S. held up a lot better. Now, one of the things that we wrote about a week and a half ago and sent out to folks was talking about would the lows from January 24th, and then we retested. We talked about a retest, and in the last 2 weeks we've kind of retested the lows from January 24th. We kind of hit those same areas and rallied on February 24th. And so we're back now with the declines that happened late last week and today. We're kind of back down at that level. So we are, look, a lot of the decline over the last 3 months, the S&P has held up relatively well compared to other parts of the market. The Russell 2000, the NASDAQ, are both down now over 20%.
And those are your smaller names, smaller companies,
small cap,
heavy tech,
growth,
right, high growth names.
Yeah, and so here are, listen, we mentioned in previous videos and in updates, we talked about this year possibly having a similar look and feel as the fourth quarter 2018. The last video that we did jointly here, we mentioned fourth quarter 2018, where in the fourth quarter you had the S&P drop 20%, you had the NASDAQ down 25%, the Russell 2000 was down 28%. The NASDAQ and the Russell are pretty close to those declines with where they are now.
Yeah.
Now the S&P isn't as much, but that's because, for example, energy stocks are up 40-50%, and energy, so that's helping
right.
keep the S&P. Utility stocks are keeping the S&P up. But your blue chip, a lot of the names that people know. So I'll give some names: Nike, Starbucks, Caterpillar, Home Depot, Facebook, Visa, Honeywell, Disney. All those companies are down anywhere from 22% to 50%. From where they were just 3, 4, 5 months ago. Those are some big declines.
And those were companies that really were on a tear.
Yeah.
I mean, we're talking about NVIDIA is a great example, for instance. I mean, just what a barn burner. I mean, they have just such a corner on the market in so many different areas in tech, like chip manufacturing and servers and artificial intelligence, all these kinds of things. And they got hit really hard as of late. And some of these names, I mean, NVIDIA, you mentioned, Microsoft, Disney, Chipotle, Airbnb, really were having better quarters than we had ever seen them have. And I think it was a combination of that. The rate hikes that were expected would hit your higher growth names harder.
Yep.
Your smaller companies would be hit harder. But the kinds of levels that we've seen of the selling in those particular names seems to be quite overdone.
Well, I think so, at least in the short run. I mean, if you take a look, we've talked for years, consumers, when you look at consumer sentiment, you want consumers to be pretty positive because they have to go out and spend money, and 70% of GDP in the U.S. is consumer spending. So you want consumers to feel good. On the investor side, when investors feel great, market, that normally means because markets are at highs or on fire, and typically you don't see great returns for the next 6 months, 12 months when consumers are uber bullish. On the flip side, when investors get very bearish, when financial advisors as a class get bearish, you tend to see really strong numbers looking out 6 months, a year. And right now, pretty much the three indicators that we follow that have been the most predictive of stock returns looking at a year all are painting a picture of a lot of negativity, a lot of pessimism in the marketplace. A lot of panic selling has happened, which again doesn't mean that in the next week or month the markets can't go lower. But the bottom line is, when you get quality companies, you rattled off names of companies like Microsoft and Airbnb and Chipotle who had amazing earnings reports. Right. You mentioned best quarters they've basically ever had. And the stocks jumped 5 or 10% immediately, but then it was too hard to fight the tide in the last couple of weeks of all this selling. Sure. And so everybody, it's the baby getting thrown out with the bathwater. And so when you look out 6 months, a year, year and a half, one of the reasons that we don't have any clients that are pedal to the metal 100% in stocks. Right. We want to have dry powder so during times when pessimism gets really high, investor sentiment gets really negative, and you see really great, well-run companies down 20, 30, 40, 50%, that's a good time to reallocate and do a little bit of buying, right? Because you can find great buys.
Yeah, I mean, as of where we were at, again, about a year ago or so, we've seen, really, when we had March 2020 with COVID, it was a lot of quick sales, right?
Yep.
We saw a massive market move down, 32%, etc. And my worry right now, especially in such an unknown quantity that we have with COVID was the same. When no one knew what was going to happen. Right. 6 months, a year, very few people, I think, at the time thought we were going to be 2 years into this. Yeah. And that's kind of, I think, a similar situation where we're at now with the war is, if something happens to resolve this, markets will snap back like a rocket very quickly. And I get very skeptical about trying to guess in a
Right.
global
Yeah.
conflict
Yep.
what market returns are going to be like
Yeah.
3 months from now.
Yeah.
And that I just want to make sure we
Yeah.
reiterate that the actual effect to your portfolio right now might be minimal as
Yeah.
to what because we cannot rock the boat with
Right.
such an unknown quantity.
Well, that's exactly right, and that's why our what we've done in the past is when we see larger declines, that we will use that time to deploy a little bit of the funds, but we don't make huge moves in or out because it is impossible to time. And what you do know for sure is the lower that high qualities go, and again, like we've talked about before in videos and in email updates, there were a lot of parts of the market that were way too frothy last year. Whether it be crypto, whether it be SPACs, whether it be the EV space, whether it be
Our favorite
tech,
GameStop.
games, yes, the meme stocks.
Right.
Yeah, I mean, a lot of these areas were
AMC
just
theaters.
on fire for a long time. Money was chasing those areas, and again, even if in the long run they're going to be great investments, when too much excitement, too much money, and the returns have skyrocketed in different areas of the markets, it always ends the same way. They need a 20, 30, 40, 50, 60, 70% decline to kind of, take some of the froth out of the markets. And we've seen it over and over. Well, a lot of froth has come out of this market. And along with it, a lot of these well-run companies have also gotten thrown in and have seen major declines as well. And one of the things that is, hey, look, if we are slowly adding to the markets, whether it be in ETFs or in some cases some of the individual funds, but primarily through ETFs, if you're adding, when you've seen a big decline due to the market, looking out a year, 2 years, you're very likely to have really good returns if you added when everybody was very negative. That's just what the data says.
Right.
If we were sitting here trying to pick and jump in and out and making big moves, that's a coin flip half the time, and that's a game that most people lose. It's just too hard to do well, which is why we don't play that game. We're not actively trading and jumping in and out of names or the markets,
right.
trying to guess what's Putin going to do next.
Yeah, I mean, I freely admit I am not a wartime expert.
Yes.
No matter what,
Exactly.
how
Exactly.
much I can read about and what's going on and pay attention. And frankly, a lot of the war, no one knows how this is going to play out.
Yeah.
And so that's sort of where we're at, I think, is in a wait and see kind of approach, and just know, for me, I personally do not feel that what has happened is going to derail a 5-year outlook for how we've been, recovering from COVID globally. I think some of this is really positive in that, again, we've seen a little bit more unity with certain countries, with kind of coming together and making some better trade agreements.
Yeah.
I think that there's a lot of positives out there. This just was just out of nowhere.
Yeah.
That pulled out some interesting changes in the markets, but I think that we can really see some good numbers, and let's just hope that this thing resolves quickly.
Yeah, and so to kind of wrap, obviously, what we're saying is, hey, look, we're monitoring the situation.
Right.
Markets are volatile. They were volatile beginning in November when Jerome Powell made his pivot, and the markets had to start to figure out, okay, what's the Fed going to do? We're going to monitor the situation here. Obviously, the situation, like you let off our video in Ukraine, is so sad to see, so tough for the people there. Hopefully, we get a better resolution somewhere along the lines here, but it's impossible to predict. The one good thing from a portfolio perspective is lots of companies and parts of the market that we're in, we just heard from with earnings season. We just saw their outlooks. Business is really good. They're doing well. Sales are growing. Profits are growing. The economy still is really strong. Oil prices, higher gas prices, not a positive. But we're just going to have to see how long this lasts. And
Yeah.
like you said, things could resolve anytime. And there's a lot of different kind of resolutions out there, but things can resolve anytime. But we're prepared either way. Whatever happens, if the markets continue to stay volatile, we will continue to be here, make necessary adjustments. But we're in a good position. We are positioned as such for clients where, with the declines that have taken place, we have dry powder. We're able to deploy some of that over time. And looking out 6 months, a year, 2 years, those are likely to be, some great return opportunities for the portfolios.
Love it.
Sound good to you?
Yes, sounds great.
All right. Well, take care.
Thank you.
Thanks for watching the video. More later.